Make or buy decisions. Hello, all. These days, companies manufacture a lot of product varieties. Each product requires multiple parts to be created. Manufacturers can produce parts themselves from beginning to end, or they can buy them from suppliers. When a company is involved in more than one activity in the production process, it is said to be vertically integrated. Vertical integration provides the advantage of a smoother flow of parts and materials for production, better quality control, and higher realized profits as outsiders are eliminated. Many other companies may produce part of the finished product while purchasing certain components from suppliers. Purchasing components or services from outside suppliers is frequently referred to as outsourcing. Using a supplier may result in economies of scale advantages by pooling demand from numerous companies. Suppliers may be able to produce some items at a lower cost than we can. The essence of a make or buy decision is to compare both make and buy options, choosing the one with the lower total cost. In our example, PNW Corp is currently manufacturing all parts needed to produce product 2071. The management team has been approached by a supplier who is offering to produce one of the component parts at a price of $38. Estimated annual production totals 50,000 units. If production is outsourced, all direct material cost, direct labor cost, and variable manufacturing overhead costs associated with producing the part would be avoided. Of the $14 per unit fixed manufacturing overhead, $10 would continue even if the part were purchased from the outside supplier. Our analysis on whether to continue making the part or to outsource the part to a supplier takes 3 steps. The first step is to determine the relevant cost of continuing to make it ourselves. Second, we want to compare the making of the product to the cost of buying it to determine the financial advantage or financial disadvantage. And then 3, we want to determine the maximum price that we should be willing to pay the outside supplier per unit if we agree to outsource the production of the part. The relevant costs include all costs which are avoidable if we decide to purchase the part from the supplier. Those costs include direct materials of $14 per unit, direct labor of $10 per unit, variable manufacturing overhead of $2 per unit. In addition, $4 of the fixed manufacturing overhead would be avoided, as fixed manufacturing overhead per unit totaled $14, of which $10 is unavoidable and will not change. The total relevant costs are $30. By being avoidable, the $30 represents our cost of producing the part. Determining whether there is a financial advantage or not to purchasing the part requires that we compare the cost to make the product with the cost to buy it. On the make side of our comparison, we multiply the per unit manufacturing cost of $30 by the 50,000 units to get a total cost of $1,500,000. This amount can be looked at in 2 ways. On the one hand, it represents our cost for producing the product. On the other hand, it also represents our cost savings if we outsource production to the supplier. To the $1,500,000, we add the additional contribution margin of $300,000 to be gained using the freed up facility space. This amount represents the opportunity cost for the make or buy decision. An opportunity cost is the benefit that is lost as a result of pursuing some course of action. Opportunity costs are not actual cash outlays and are not recognized in the formal accounts of an organization, but they are relevant costs to the decision-making process. In our example, making the product would result in a give up of $300,000 in contribution margin that would benefit the company from freeing up facility space. Adding the manufacturing cost of $1,500,000 to the $300,000 in opportunity cost results in a total cost for making the part of $1,800,000. The column labeled buy is used to multiply the purchase price of $38 by the 50,000 units that we would purchase. The total cost to buy the part from the supplier is $1,900,000. The financial advantage is always determined by subtracting the cost to buy from the cost to make. In this case, we subtract the cost to buy of $1,900,000 from the cost to make of $1,800,000 to get a negative $100,000. The negative amount represents a financial disadvantage, meaning that outsourcing the part in this example would result in a decrease in profitability. A negative amount is always a financial disadvantage, while a positive amount is a financial advantage and represents an increase in profitability. This, however, is not the end of the analysis. Knowing that the purchase price of $38 creates a financial disadvantage gives us the opportunity to negotiate price with the supplier. To determine the maximum price that we should be willing to pay, we divide the total cost to make of $1,800,000 by 50,000 units. The result is $36. Knowing that $36 is the maximum purchase price that we would pay gives us the information we need to sit down with the supplier and determine whether a deal can be made. This problem provides an excellent example of the steps involved in a make or buy decision. First, you must always determine the cost to make the product. Next, you determine the cost to buy and compare the two amounts to determine whether the pricing produces a financial advantage or disadvantage. Then finally, determine the maximum price that you're willing to pay if a financial disadvantage exists, and negotiate given that price. It should be noted that knowing the maximum price to be paid can be determined at any time once the cost to make has been calculated. Thanks for viewing the video. Good luck.